Hey everyone, Zachary Jensen, managing partner at TaxWise Financial Services here, where we're helping small business owners maximize tax savings and grow with confidence. Today, we're going to go over the top 10 critical Tax Cuts and Jobs Act provisions expiring in 2025 this year that greatly impact investors and families. As we move through 2025 here, a lot of clients have been asking us, hey, what's going on with the tax court? I know there's a new president coming in. What's going to change with taxes? So I wanted to go over what's first expiring. That way we can see either if they're going to extend it or if they are going to keep it in place or get rid of it. So let's jump into number one, which applies to families, investor or not, the child tax credit. The child tax credit expanded under the Tax Cuts and Jobs Act to $2,000 per child under 17 and has been the lifeline for many families here in the United States paying their taxes year after year. It not only reduces taxable income, but also provides a refundable portion of $1,400, ensuring even family members with little to no tax liability can benefit from it. For families balancing rising childcare costs and education expenses, losing half of this benefit would be a strain already on a tight budget. A reduction to the pre-tax cut in Job Act level of $1,000 per child would also disproportionately impact low-income households, which rely heavily on this credit to cover basic necessities. So the potential rollback here is especially concerning for families with multiple children. A family with 3 dependents, for example, could lose $3,000 annually in tax credits, which is a substantial amount that could otherwise fund things like groceries, healthcare, school supplies, etc., that apply to this sort of demographic. The refundable portion of the credit is crucial for households without significant tax liabilities, and it would also shrink, further disadvantaging those who need it most. For small real estate investors, the child tax credit has indirect implications. Many investors rent property to families, and reduced disposable income among tenants could impact their ability to pay higher rents. So this is something that as an investor you would want to keep your eye on. This ripple effect demonstrates how even the tiniest change in the tax code can affect the economy and how the expiration of family-focused tax provisions can indirectly influence the broader economy and its stability. Now moving on to number 2, the standard deduction. The nearly double standard deduction introduced by the Tax Cut and Jobs Act simplified tax filing for millions of Americans and reduced taxable income for those who do not itemize deductions. Families with straightforward finances no longer needed to navigate complex tax rules to maximize deductions, and small real estate investors benefit from this streamlined approach as well. However, if the standard deduction reverts to its pre-Tax Cuts and Jobs Act level, $12,000 for married couples filing jointly and $6,000 for single filers, many taxpayers will actually see higher tax bills as a smaller deduction increases taxable income. The reduced deduction would disproportionately impact middle income families who rely on it to lower their tax liability. For example, a family earning $75,000 annually might see a significant increase in taxable income, reducing their ability to save or invest. Additionally, the burden of keeping detailed records for itemized deductions, such as medical expenses, charitable contributions, and mortgage interest, would also return. This could discourage some taxpayers from seeking deductions that they are entitled to and leave them paying more in taxes unnecessarily. Now let's move on to number 3, the state and local SALT for short deduction cap. The SALT deduction cap, limited to $10,000 under the Tax Cuts and Jobs Act, has been a continuous issue since its introduction, particularly in the high income states like California, New York, and New Jersey. For families in these states, the cap meant they cannot deduct the full amount of property taxes, state income taxes, or other local taxes from their federal income. And if this cap is extended or made permanent, families in high tax areas will continue to face higher federal tax bills, reducing their overall financial flexibility. For small real estate investors, the SALT cap is particularly relevant. Property taxes is a significant expense for landlords and often are a major part of their overall tax strategy. The inability to fully deduct these taxes increases the cost of owning properties in high tax states and potentially makes some investments less profitable, which could lower the value of those investments. The expiration of the SALT cap could provide some relief, especially for investors managing high value properties with substantial property tax liabilities. And without the cap, these taxes would once again become fully deductible, improving cash flow and potentially offsetting other rising costs such as maintenance and renovations and so forth. Now moving on to number 4, Qualified business income, QBI for short. The QBI deduction, introduced by the Tax Cuts and Jobs Act, allowed business owners, including many real estate investors, to deduct up to 20% of their qualified business income. This provision significantly reduced taxable income for small businesses structured as pass-through entities such as LLCs, partnerships, and S-corps. For families operating small businesses or managing rental properties, the QBI deduction has been a game changer, allowing them to reinvest savings into their operations or expand their portfolios. And if QBI expires, small business owners, real estate investors, and the like will face a substantial increase in taxable income. For instance, a landlord earning $100,000 in net rental income would lose a $20,000 deduction, potentially increasing their tax liability by thousands of dollars. This change could discourage investors in new properties, limit renovations, or even lead to higher rents as investors attempt to offset the increased tax burden. Moving on to number 5 here, the estate and gift tax exemption. The Tax Cuts and Jobs Act doubled the estate and gift tax exemption to $11 million per individual and $22 million per couple, allowing families to transfer significant wealth tax-free. This provision has been especially beneficial for real estate investors with sizable portfolios, as it enables them to pass down properties without triggering substantial tax liabilities. However, if the exemption reverts back to the pre-Tax Cuts and Jobs Act levels of approximately $5.5 million, families with large estates could face significant estate taxes, forcing heirs to sell to cover tax liabilities. Moving on to number 6, bonus depreciation. The Tax Cuts and Jobs Act introduced 100% bonus depreciation, allowing businesses, including real estate investors, to immediately deduct the full cost of qualified assets such as machinery, equipment, certain property improvements. These provisions have been instrumental to improving cash flow and incentivizing investment in new assets. However, this benefit is set to phase out, with deductions decreasing 20% annually starting at the end of 2022. Here we are in 2025, it's currently at 40% and completely expiring after 2026. Without extension, taxpayers will revert to slower depreciation schedules, reducing upfront savings and reducing overall tax burdens. For example, a property owner who invests $50,000 in property improvements can currently deduct certain aspects of that over the course of 1 year to the tune of 40%. But losing that benefit would make such investments less financially appealing, delaying renovations or upgrades that could enhance the property's value and attract tenants. This is not just for real estate investors either. For small business owners, not being able to write off equipment and taking the full depreciation can put a big strain on cash flow and after-tax income. Moving on to number 7, mortgage interest limits. Under the Tax Cuts and Jobs Act, the mortgage interest deduction was limited to the interest paid on the first $750,000 of mortgage debt, down from the previous $1 million cap. While this change primarily affects higher income households, it has also influenced small real estate investors with significant mortgage obligations. And if this limit expires, it could raise questions about whether taxpayers will return to the higher pre-Tax Cuts and Jobs Act threshold or face additional restrictions. Now, since inflation has happened, especially in states like California and New York, many think we could see anywhere from 1.25 million to 1.5 million. Some even think 2 million could come into play as far as the limit on mortgage interest deduction. But again, that's all speculation.